And welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
Tracy, you know what topic we never really talk about or really do is like we never really do anything related to like personal finance.
Like what to actually do with all the information that we talk about on a bi-weekly basis.
Yeah.
What it means for making money.
It's like a huge part of like finance media, but it's like, we like to talk, usually like, well, what's going to happen with quantitative tightening
It's
or something?
a tough one because I feel like you can talk about it generally, but also there's the temptation, a lot of people end up doing this, to give specific recommendations.
Yeah. Right, like get this credit card.
Buy Tesla.
Or, either buy this stock, get this credit card, don't buy avocado toast, like all this stuff, or like, move your money. But like, it's kind of like cliched topic, but like on the other hand, I do think it's interesting right now because we've just had this like sort of extraordinary like 3 years of like inflation, which many people have never really experienced in their lives. And so to my mind, that raises some interesting questions like, how is this going to like change people's behavior? And what have people done in the past during periods of inflation? Like there are really interesting sort of like personal finance, spending, investing questions that like will come out of this era.
Well, absolutely. And also the prospect of just finally actually earning some interest on a basic savings account. I know it's still below the level of inflation, but for people who've been earning 0% for most of their professional lives, I think it's very exciting.
I think now it's kind of positive, right? Because you could probably get like 5% in a CD and maybe inflation will be 3.5%. Right. I asked my dad recently about his memory of the 1970s. I was like, what was that like? And the first thing he said was like, oh, you could really get a lot of money in a bank account in those days.
Oh, there you go.
Yeah. So, there's all kinds of interesting things about like how people actually deal with
right. And also what happens when we have a sort of regime change and how do people react to it and how much have things actually changed?
Well, and we've been talking about some of the real estate episodes we've done, like how much people like anchor to the ZERP era. They're like, as if like that was normal.
Yes.
And so it's like, when have people adjusted? Is there still a big adjustment left to go? Like, there's just some really interesting questions.
Absolutely.
Okay, well, I think we should talk about them. And we really do have the perfect guest. We are going to be speaking with Morgan Housel, longtime writer, the author of the best-selling book, The Psychology of Money. He has more books coming out, hugely popular in this area. Morgan, thank you so much for coming on Odd Lots.
Well, Joe and Tracy, happy to be here. Thanks for having me.
Can I just say, all right, I'm going to just say something just to set the scene a little bit. Like I said in the beginning of the conversation, like personal finance as a genre is a little hackneyed, it's kind of cliched.
But Morgan does it well.
Years ago, like 2011, 2012, I was a Business Insider. Morgan was at The Motley Fool. Oh. And I said to my former colleague at BI, Sam Rowe, Morgan is the first personal finance writer that I like. And now he has this huge...
That's high praise. High praise from Joe.
That means a lot to me.
I just want to say I was long Morgan Housel very early on.
Well, I was long Joe during that period as well. So this is a
What have
mutual
you been
thing.
up to since then?
I feel like I've always done the same thing since 2008 when I started this, which was, you mentioned most personal finance writing kind of falls into two buckets. It's either here's the credit card you should use, or here's the hot stock you should buy. The credit card part, I was never that interested in it. And here's the stock you should buy always felt almost immoral to me because you don't know who's reading your stuff. Is this an 18-year-old day trader or a 90-year-old widow? Like, who are you recommending this to? So because of that, I just kind of naturally fell into this bucket of like, what's going through people's heads? I don't want to give anybody advice. I don't want to tell anybody what to do because I don't know you, but I'm really curious what's going on inside your head. Particularly, I started as a writer in 2008. So the world was falling to pieces. And it was just this idea of like, well, what the heck just happened here?
Yeah.
And I think once I kind of realized that you could not explain 2008 through the lens of a finance or an economics textbook. It's just not in there to explain the bubble, the bust, the bailouts, not an economics textbook. But psychology had a lot to say about it. Sociology, like keeping up the Joneses, that perfectly explained the housing bubble. So there are all these other fields outside of finance that filled in the gaps. So that to me was like, I'm just really interested in how you can connect psychology and sociology and political science to try to explain what people are thinking rather than what they should do.
Yeah, both Joe and I, we sort of started our financial journalism careers around 2008. And
we're all the class of 2008.
And it was a great time to do it because you were sort of on the same level as everyone else. No one knew really what was going on. But Talk to us a little bit more then about your approach. How does taking that sociological or psychological angle actually inform the way you think about personal finance investing?
Well, I'd say there's two elements to this. One is I'm a writer, and then the other is I'm interested in behavioral finance. And you really have to mix both of those because in writing, particularly as a finance writer, if you're just writing about data and charts, like a lot of people, even in the industry, it's like it's boring. You're not going to catch anyone. So you got to tell a good story. And so I'm always trying to find examples from fields that have nothing to do with finance that explain how people think about greed and fear and risk. Because not only do I think that gets you closer to the truth of what's happening in finance, if you can really get like, why are people thinking the way they are? But and from a writing standpoint, I think it's more interesting. If you can be like, oh, here's a story from World War II that explains how people think about risk. And let me tell you how that, bleeds into finance. I think it's more interesting as a writer to catch people's attention that way.
So we're recording this at an event in Huntington Beach at Future Proof. Isn't one of your most famous stories about parking cars in Los Angeles at one point, being a valet?
So yes, it was a hotel here in Los Angeles that I was a valet at during college. And it was a high-end 5-star hotel, a lot of rich people coming through. And there was one member who was just an absolute animal with money. He was very, very wealthy. I think he was worth hundreds of millions of dollars. And money has never burnt a hole in someone's pocket so fast. He wandered around. He was always drunk, and he wandered around with a stack of $100 bills, I swear, 6 inches thick. And he would just flash money like no other. And we did a lot of errands for this guy as a valet because he tipped very well. And one day he came to one of my colleagues, and he peeled off a thick stack of $100 bills. And he said, go down to the jewelry store down the street and buy me some gold coins. I think there were $1,000 gold coins. And he came back with all these gold coins. And this guy, with a group of friends, sat there at the Pacific Ocean, skipping the gold coins to see how far they could go.
Oh my God.
And I remember thinking, I was 21 at the time. And I remember watching this and thinking like, how long can this last? And it was probably 10 years later that I said, what's this guy up to? And I Googled his name, and sure enough, he went bankrupt. His company went out of business. And it was like, when I saw the headline, it was like, of course this guy. So to me, it was always so interesting that he was so smart. He was an entrepreneur who made a lot of, his companies built parts for satellites, and he had a patent that's in every Wi-Fi device. Like, he was such a genius, technically. But his relationship with money was so broken and so bad. So that was like, it doesn't matter how smart you are. It's not about like what your IQ is. If your behavior with money is wrong, you're done. It's out. And then there's a flip side of that that's true too, which is that some people who are not that intelligent by their test scores or whatever, but they have a great behavior with money, can do spectacular over time.
I'm probably taking the wrong lesson away from this anecdote, but did anyone go after the coins?
For all I know, they're still there.
All right, later today, Joe.
This is good to know. So this is, obviously there are going to be individuals who maybe don't have a high income but do a good job of accumulating savings over years, or people with massive incomes and then blow it, all kinds of things. You always hear these other stories about like cohorts of people who went through something together, like people who came out of the Great Depression and then they were like hoarders or something like that, or people who came out of whatever it is. Is that true? People say that all the time. Or people who experience like the inflation in Weimar, Germany, and when you in your research, when you I take it you read a ton of history. Like, does that seem to be a real thing?
Yeah, definitely. I think every generation experiences the economy in their own unique way, and those experiences, particularly what you experience in your teens and 20s, like your formative years where you're starting to pay attention to the economy, really sticks with you. Everyone has seen or probably heard of the studies about the generation that went through the Great Depression, and then right after that it was World War II. So that was 15 years of hell. Yeah. And those people coming out of it, like that stayed with them forever. And there have been academics who've measured how that impacted them. They're very scared of debt, didn't want to invest in the stock market, way more so even when you talk about people in Weimar, Germany, or the people who went through World War II in Germany or in France or in Russia. Those people were completely scarred economically for the rest of their lives. And more recently, all three of us became young adults in the early 2000s. So for me, 9/11 was the first like adult big event.
Right.
And then so that was massive. And I think for our parents' generation, who were adults in the 1990s, when things were so, at least in relative terms, calm, stable, prosperous, not just economically, but politically and geopolitically, were like so solid. And there was a recession, there's a hiccup in 94 and 98. But for most people, that was like, unless you were a bond trader, it didn't matter. The 90s were great. 9/11 was like, oh, wow, like we really got knocked down here, but that was a one-time event. Like America is still as strong as it's ever been. And then in 2008, it was like, whoa, we got knocked down again, like 2 times in the last 8 years. That's pretty bad. And then COVID in 2020, it's like the world broke again. Like 3 times in 20 years, the world has broken in the United States. And I think that is like, what's the quote? Fool me once, shame on you, fool me twice. Now that people have been fooled, so to speak, 3 times in 20 years, I think our generation, believes that the world breaks every 5 to 10 years. And I think that's the truth. I think the previous generation that was America strong and stable and nothing bad happens, that was the anomaly. And I think we're a more pessimistic generation because of it.
So I was kind of going to go into that. You know, the one thing that I've been really fascinated by over the last few years is what sort of strikes me, and particularly in like markets and investing, is this sort of like, I almost call it like a sort of like nihilistic bullishness, like you saw it like buying NFTs or Dogecoin or whatever, where it's like on some level, it looks like optimistic speculative activity, like maybe we saw in the late 90s. But it also has this sort of like edge of like, none of this really means anything.
Well, you're knowingly chasing a bubble or buying a lottery ticket because there's no other way to make money.
The Wall Street bets like bragging about going broke in your Robinhood thing. Like it seems like we're in this era of like speculation, but not coming out of a place of optimism.
I almost think like the YOLO mentality of trading NFTs or whatever it may be is actually like comes from a very pessimistic place. If you're optimistic, then you're like, I want to own the S&P 500 for the next 50 years. That's optimism. Pessimism is it's all going to go to hell anyways. Let's just throw it all on an NFT.
Yeah.
So it looks from the outset like a very like bullish, like I'm so bullish on crypto. No, I think it comes from a very pessimistic place. You made this point years ago that stuck with me during the gold bubble, if we call it that, around 2011, that there's nothing more pessimistic than betting on a rock versus betting against. Whereas like if you're optimistic, you bet on people. Yeah. And how pessimistic do you have to be to say a rock is going to outperform humans? It's like the most pessimistic thing. And I think there's there's an analogy in there with NFTs.
Yeah.
Wait, I take the point about people being pessimistic about these big sort of sociological breaks in society. But if you look at the legacy of the 2008 financial crisis, it wasn't necessarily a terrible time to start accumulating wealth and money. You know, if you bought the S&P 500 in 2009, right up until 2020, you'd be doing reasonably well. Like, what do you think the legacy is of that particular era where we're still sifting through the wreckage of 2008? We have ultra low interest rates. Everyone's worried about deflation and subpar growth.
I remember, I don't know if it was 2011. So if I'm getting this date wrong, I'm sorry. But I think it was 2011 and the market went up substantially. Does that sound right to you? 2011?
I think so.
25%. Maybe it was 2010
2011
or 2010.
was a bad year. We bottomed in October.
Maybe
that
it
was also the year we had like Fukushima. That was a rough year.
Maybe it was 2010. Maybe it was 2012. I forget the year. But the market went up.
2012, I think, was a pretty
maybe it was 2012.
year.
The market went up 20 or 25%. And I think it was Gallup who polled Americans and said, did the stock market go up or down this year? And it was like 60% of Americans thought the market went down during a year when it went up 25%. I actually think this was 2009, which makes sense.
Okay,
that makes more sense.
Yeah. Right.
And so that wasn't. I think this explains the question of like, in hindsight, it was a great time to accumulate assets. But during the time, even a year when the market went up 25%, people were so sure that the economy was bad that they assumed the market went down.
Yeah.
And Joe, both of you will remember this. From basically 2009 to 2016, if you were a bullish on the stock market, you looked kind of like a fool and you got dragged on Twitter. This was like, oh, the CAPE ratio is too high. And there was all this. So in hindsight, it was a generational buying opportunity, but that's all hindsight. It was very hard to be bullish during that era. And a lot of it was 2011 was double dip recession right around the corner. And the idea that the financial crisis of 2008 was just a prelude to the big crash that was coming. That was a very popular view during those years. And I think it was really hard to be a long-term bull.
So we talked about this in the intro, this phenomenon of like people sort of like anchoring to what they know. And I feel like for a lot of people, like ZIRP, really low nominal interest rates, like, oh, that's normal. And what we have right now, where like the 10 years yielding 4% and a mortgage is over 7%, that feels like aberrationally high. Like, again, going sort of back to the past, like, does it take a while? I mean, it must. I mean, you sort of, as you described it, like, it seems to like take a while for like it to sink in that it's like, no, that was then, and it wasn't necessarily like normal or abnormal, but that was a different time.
I think that does make sense, but the counter to that would be in the other direction. You know, in the late 90s, a mortgage was 7%. Right. And by 2003, it was 3 or 4%. Yeah. And I think people got used to that really quickly. That was kind of the basis of the housing bubble that peaked in 2006, is that by 2006, people were already completely used to low interest rates that didn't exist 4 years prior.
That's wild.
So I do think people get accustomed to it fairly quickly. And a lot of that, I mean, at the corporate level, a lot of that debt rolls over every 5 years. So there's going to be, like, that credit cycle is going to wash out in a fairly quick period of time. But interest rate cycles are also pretty long. Like, interest rates bottomed after World War II in the early 50s and then peaked in the late or the early 80s. Like, it was a really long cycle for them to go from 3% to 15%.
What sort of different behavioral patterns do you observe between eras of low interest rates versus eras of high interest rates?
I think because the interest rate cycles are so long, and there's only been a couple cycles in the post-World War II era. It was like they went
What were
up.
people in the 1960s doing? Tell us.
So much of that debt, though, didn't really exist. Like, at the end of World War II in 45, consumer credit barely existed at all. In fact, a lot of the GI Bill was introducing new forms of consumer credit to make sure the economy didn't collapse after World War II. It was like, we want you to be spenders. So like credit cards and installment loans, a lot of that just exploded after World War II. But then the rates were so high during that period that it really wasn't until the 90s that consumer credit just like exploded. So we don't have that much history about what it is. And so I don't think there's a ton of precedent for what we're dealing with in terms of like the consumer credit. But there's also a thing where you've seen, I know, Joe, you've seen this chart. I think you've tweeted this chart of, as a percentage of income, household debt payments right now are actually very low. Like historically near the bottom that they've been in the last 40 years. So if you just look at the nominal amount of household debt, it looks scary. But actually, as like a percentage of income, it's actually very low right now.
You know, obviously, economists, like macroeconomists, the last real inflationary period that anyone remembers was the 70s. And interestingly, like a sort of the grandees of economics, many of them came of age during the 70s. So it like looms very large. But setting aside like how academic economists think, from your perspective, we're looking at sociology and history, et cetera. Like, does this remind you of the 70s, or is that just sort of like a fake analogy because inflation was high then too?
I think the 70s were really unique too, because in addition to inflation that was so crippling, there was so much social unrest between Vietnam. All of that blended together to just an era of pessimism. So a lot of the pessimism wasn't just because of inflation or just because of Fed policy. Like, there's all these other things boiling up that made people just really upset about the state of America that all falls in it. And I think that was true in the 90s as well. It wasn't just economic prosperity. It was economic prosperity mixed with political stability, mixed with Soviet Union was gone, so America is untouchable. It was just like all these things mixed together. And I think if you view optimism solely through an economic lens, like 90% of households don't read the Wall Street Journal, don't know what the Dow did yesterday. They're putting all of these things together. It's not just, is the economy strong? It's, is Washington in good shape? Are there political fights? Is my kid's school in good shape? It's like all these things mixed in one. And I think a lot of financial economists and journalists only view it through one narrow lens, but that's not how most households think.
All right, so just on this point, I mean, one of the oddities of our current economic environment is that the hard data says we're doing relatively well, but if you look at the survey-based data, if you just look at what people are talking about on a daily basis, it's like we're already in a depression, basically. How do you explain that discrepancy?
I remember years ago someone saying that consumer confidence, like the statistic that's released, is fueled by three things: the stock market, gas prices, and politics. And to the extent that that's true, then I think it's politics is probably why that's being
partisanship
in the way it is. Partisanship, yeah. And I almost think it's so extreme that no matter, the Dow could double and the unemployment rate could collapse to 1%. I mean, someone brought up recently, I think it was Josh Brown, who was like, you guys, the stock market's near an all-time high, unemployment's 3.5%, you can earn 5% on your cash. Why are you not happy here? And I think for a lot of people, the answer is politics.
hopefully inflation is soon going to be back at target, or the Fed's target, but we don't know for sure. But we obviously, we had the highest recently had the highest inflation in 40 years. Something we haven't seen. We talked a little bit about like some of the sort of like nihilistic speculation. What do you see as some other knock-on effects from the last few years, whether it's the inflation or just the COVID disruption or anything else that we've experienced since March 2020?
COVID was so interesting because it was so binary in terms of if you were a tech worker in 2020, it would never been better. Whereas if you owned a laundromat, it's worse than the Great Depression. And the actual Great Depression impacted virtually everyone at the same, whereas COVID was so different. And so you have probably half of America for whom 2020 was a great year financially, and half for whom it was the worst it's ever been by an order of magnitude. And because of that, I think when you have half the country that doesn't understand what the other half went through, that also leads to an era of like, I don't trust the numbers. I don't trust the statistics. I don't trust the politicians because what this guy is saying is so counter to what I experienced in either direction. And I think that also just leads to an era of hyperpartisanship of like, if you're saying that about the economy, how disconnected are you in a way that we really haven't dealt with? And a lot of the reason that a lot of the policies during the Great Depression, the New Deal, got through in a semi-bipartisan way is because the Great Depression impacted everybody. 2008 was, I think, similar to that as well. Like everyone was going to be screwed if the banks went down. So it makes it easier to push through policy.
This is also my theory of why people care more about inflation than the unemployment rate, because if you personally haven't lost your job, it's hard for you to sort of envision, unemployment is at, a multi-decade low, but you can definitely see egg prices at your local grocery. Yeah. Everyone can see those. And so it seems like it becomes a much bigger talking point. But okay, let's talk about a bright spot, which is, I guess we can now earn 4 or 5% on a bank account or a certificate of deposit. That seems great.
Yeah, and it's weird. There's almost a point when if you're buying a 1-year CD right now, you can get 5.5%. It almost feels like you're robbing the bank. You're like, really? You're going to pay me that? When you've had 15 or 10 years, or whatever, of ZIRP, it's a wild thing to deal with. But both of you know this. Historically, this is normal. Yeah, I think that's what's hard to wrap your head around. Is that historically, this is what we're dealing with is not the anomaly. This is the completely normal part. And I think everything would be better if we live in an era, if we never go back to ZIRP, everything would be better. If we have an era where there is some sort of anchor on speculation and people can earn a decent return on their cash with some level of risk, I think that's so much healthier in every aspect.
So one of the weird things, though, just on that point was, earlier this year when interest rates on bank accounts were starting to creep up, we actually didn't see that many people who seemed to actually be moving their money into higher yielding bank accounts or money market funds. It didn't really happen, I guess, until March when we had the SVB drama. But what do you think accounts for that? Is it just it takes people a while to realize this is something available to them?
Well, I mean, I think there has been quite a bit that have moved into money market accounts. I mean, what are money market accounts now? $5 trillion or something. So there has been money that's moved over. But I think the average American just doesn't think about it that much. And maybe if you don't have a very high level of savings, there's kind of a why bother mentality. Yeah. Whereas I imagine most of the high dollar amount accounts have moved pretty quickly. And it's a wild thing if you think about, anyone's guess of future stock market returns is as good as anyone else's. But if you think like at valuations, stocks return like maybe 6 to 7%, something like that, then my guess is as good as anyone else's. So let's say stocks return 6 and you can earn 5.5% in a money market account. All of a sudden you're like, for the first time in 20 years, it's not an easy decision to make.
Yeah, I have to say, so I think this has come up a few times, on the show. And the first couple of times we discussed it, I'm like, 5%, like, it's not that.
Have you finally been rate pilled, Joe?
Yeah, it's like well, it's not. It doesn't really seem worth it to like move it over. But now, like after like a few months, it's like actually, yeah, that is meaningful. And as you say, like if historical returns on the stock market are like maybe 6.5% or something like that, and now you can get 5% like truly risk-free
on a money market account.
Yeah, that's pretty good, isn't it?
But I think that's the world you should live in. There should be some anchor against speculation. There should be some temptation for your money that is not just a YOLO mentality.
Do you think, like it doesn't feel right now in September 2023 that the speculative fervor that we saw that really peaked in 2021, like it still feels like there's still like some embers of that, right? Yeah. Like you still see meme stocks. Like it's not much, but like it still exists.
Bitcoin's still 25,000.
Yeah.
And I think it's wrong to just associate speculative frenzies with interest rates.
Yeah.
You got to remember, 1999, like the peak of the dot-com bubble, interest rates were higher than they are today. So you can have a crazy bubble with interest rates.
Yeah.
I'm sure it plays a role. But I think just explaining it as like every 10 to 20 years, people collectively lose their minds financially. Like irrespective of interest rates make it easier to do it. But you could have a giant speculative bubble with interest rates where they are today. So it wouldn't surprise me, even with the hikes that we've had, if there's a new crypto bubble, a new meme bubble, like whatever it would be. I think all of that is detached from interest rates.
It feels to me like social media is also I don't want to say new, because we had message boards in 1999 and 2000 where people were talking up stocks, but it feels like that's sort of added fuel to that dynamic where people are chasing bubbles rather than running away from them.
Yeah, and it turns into like a tribal mentality, particularly in the crypto space, where your willingness and your ability to buy certain kinds of crypto is your identity. And I think that also existed in the 1990s. Like, I'm a tech stock trader. That's your identity.
Yeah.
And I think any time in finance where you say, I'm a blank, whatever it is, even I'm a value investor, anytime you get that kind of tribal identity, you're like outsourcing your thinking to the madness of crowds. And I think it's a really dangerous way to invest.
Is there a way like to deprogram that deprogram someone or deprogram yourself? Because like that lock-in effect where like some way that you invest, and I think even like professionals have this all the time. Like it seems really hard. Just changing your mind.
It's really tough.
Is there have you, in your research, are there tools or like ideas that actually work to like get better at changing our minds?
I don't know if there's tools or ideas, but I think some people are just much better at being independent thinkers than others. Even if, like I said, if you said, I'm a value investor, it seems so conservative and so benign.
Yeah.
But Josh Brown has made this joke that a lot of value investors just end up owning like typewriter companies for 20 years.
Right.
And it's like, so even if you lock yourself into that tribe, it's not safe.
But even like, I was thinking too, like, in the beginning, like, and to still have this fight, it's like setting aside even investment to like team transitory or like team person. Like when we were debating inflation, it's hard to change your mind.
Really
even
hard.
With new data.
And I think social media makes that really hard too, because now there's like a timestamp on every call that you've made in a way that there wasn't before. And people would much rather be consistent than be right. And the reason that is because I think when most people are looking at a pundit online, they want their pundit to be consistent. And most people, like if you tell people what they want to hear, you can be wrong forever without penalty. So if you want to be pessimistic and you listen to Peter Schiff for 10 years saying the dollar is going to collapse next month, even if it doesn't, he told you what you want to hear.
Yeah.
And you're going to buy his newsletters and keep on going. So in the punditry business, that's the right way to do it. Even if it's like from an economic point of view, it's terrible.
Well, we're very good at avoiding consistency on this podcast, Joe.
Yeah,
we don't have that problem.
We don't have.
We change our minds all the time. No, wait. You mentioned value investing, and it does feel like, at least up until 2020, and maybe even beyond it, the big money was in chasing momentum.
Yeah.
What does that mean? Because we're talking about the fallacy of groupthink, but on the other hand, if you have a really good handle on a certain narrative or what's going to attract people to a particular investment, it feels like an advantage.
Yeah. There's a great George Soros quote where he says, whenever I see a bubble, I rush in to buy it. And it seems so counterintuitive. Like, why would you want to buy a bubble? I think I don't want to put words in his mouth, but I think his thinking is he understands that a bubble is very likely to grow bigger than you think, just because everyone else is going to watch their neighbor get rich and they're going to come in, which is exactly what happens every single bubble. So I think that like the chasing of momentum, it has a huge behavioral component behind it. Now, the hard thing is like getting out before everyone else, which someone like George Soros can do, but virtually no one else can. So it's like that has no appeal to me whatsoever, because the idea that you're going to get out before everyone else when you're chasing their behavior to begin with is I think, wrong thinking.
So we talked about in the beginning, like this sort of like, talk about how personal finance, personal money is like, there's like two kinds and they're both kind of not that great. Where one is like giving people stock picks and, let's be honest. And the other one is this sort of like, okay, here's like what credit card to get to like maximize miles. setting aside like the speculative frenzy or investing or meme stocks, do you think what we've experienced over the last 3 years will like meaningfully change how people consume going forward in some ways, like just general consumption patterns, savings patterns?
I think it's not necessarily the last 3 years in terms of COVID being the last 3 years. I think it's the last 10 years of social media that just massively changes it. It's always been historically that there's no objective level of wealth. Everything is just relative to the people around you. Your neighbors, your coworkers, and you're like, relative to that person, here's how much money I have. Here's how big my house is.
You always hear people say things like, oh, well, like compared to like a king in the 1800s, you're so rich. It's like, yeah, great, but I'm not.
But my neighbor has like a big screen TV.
Everyone just looks at the people around you.
Yeah.
But now it's the people around you is Instagram, and it's a curated highlight reel of like everyone around the world. Someone said recently, it went from keeping up with the Joneses to keeping up with the Kardashians.
Yeah.
Like that's what social media did. It went from now you're comparing yourself to the highlight reel of everyone's life. So I think expectations of what people's definition is of a good life just exploded over the last 10 years. I can see it with my 7-year-old son who spends time on YouTube and what his definition is already at age 7 of what success looks like. If you watch Mr. Beast all day, success is like driving a Lamborghini and throwing $10,000 at strangers. And I think there's an element of that in social media.
Is your son skipping gold coins?
It turns into that. But it used to be when you compared yourself to your neighbors, it was much more mundane than comparing yourself to Instagram.
Interesting.
So I think that's the biggest change in consumption. It's just an inflated expectation. And it's the Louis C.K. joke of everything's amazing and nobody's happy. If your expectations grow that much, then even when there is great economic growth and the stock market's doing well, it never feels like it's enough because you're comparing yourself to something crazy.
I mean, listening to that, it sounds kind of dire in the sense that I don't think social media is going away anytime soon.
No.
What does that mean? Like for the long term, is there a way for people to break out of that mindset?
I don't think there is. And of course, social media is not going away. So it would not surprise, I'm not a forecast kind of guy, but it would not surprise me if in the next generation, we have very good economic growth, very good stock market growth, and no one is even a morsel happier for it. I think that it's already happened over the last generation. I mean, that's almost the whole history of economic growth, like great growth, but everyone just gets accustomed to it.
Yeah.
And there's parts of that that's great. That's what keeps people wanting to push harder and innovate more is because it never feels like it's enough. So a lot of that is a great thing. But if you're looking at, it's easy today to think, oh, our grandkids, their real income is going to be double or triple of ours. And that means their life is going to be so great. It's like the second part of that is where people make a mistake. There's a good chance that our grandkids, their real income will be double or triple of ours. And I would bet heavily that they will not be any happier for it.
Right. They'll be like, that guy over there has a bigger spaceship than I do.
That's always exactly what it's going to be. Yes.
That guy's been to Mars.
Yeah. I only went
I've only been to the moon.
Yeah.
Right.
Well, what do you do, like in your personal life or with your family, or how you like think about these things to like escape some of these traps that are very hard to fall into? It's
not easy to do. I think my wife and I, who's in the room right now, are pretty good at just being like, this is what makes us happy, and we're not gonna let a lot of external influences let us in. But it's hard for everybody. No one can escape the comparison game.
Yeah,
I think it's just a natural part of how humans behave is just compare yourself to your peers. So it's not an easy thing to do. I think there is something to say for the idea that nobody is thinking about you as much as you are. So everyone is like, oh, I got to get the nicer clothes so that people will be impressed with me. They're not impressed with you. And they're thinking about themselves. No one's thinking about your car. Nobody's thinking about the size of your house. They're all busy thinking about themselves. Once you understand that, then I think your aspiration for showing off like plunges. And that's what you need to be like, I'm just happy with this, hanging out with my family, going for a walk with my kids. I don't need to show off to people who aren't paying any attention to me. But some people can do that better than others.
We've been talking a lot about how human beings respond to change and the idea that maybe we're going from an environment of low interest rates to one of high interest rates. You have a new book coming out. My understanding is it's all about change. Is that right?
It's about things that never change over time, which I think is the more important. I got the idea many years ago. There's a Jeff Bezos quote that I'll paraphrase. He said, people always ask me what's going to change in technology. And a better question is what is never going to change. And he said, you can never imagine a future at Amazon where customers don't want low prices and big selection. So because you can't imagine that future, you can invest all of your money into that, knowing it's going to be just as important 50 years from now as it is today, which you can't say about most other technologies. Most other technologies have a shelf life of a year or two, and then they're obsolete. So it was the idea that, part of this started for me with just the observation that both of you know, most economic predictions and stock market predictions are very bad. our ability to predict what the stock, it's not very good. So, and I think part of that reason is because we try to pay attention on what's going to change. And if we can instead pay attention on what we know is not going to change, how people pay attention and respond to risk and greed and fear, let's just focus on that, knowing for certain that's going to be part of our future, rather than pretending like we can predict what might change in the future.
Well, it's funny, like even on the stock market, like our friend Sam Rowe, like who has a great newsletter, tkr.com, his whole thing is like stocks usually go up.
Yes.
And, we could talk all about, what's going to happen with like, if the Fed doesn't hike, the Fed hikes in November and the Fed hikes twice, et cetera. But like history seems pretty clear. Like in the long term, the line basically goes up.
There's another version of that. Derek Thompson from The Atlantic, I think he wrote this in like 2015, 2016. He said, since 2008, there have been hundreds of thousands of articles written about the economy and what's going to happen. And you can summarize all of that period by just saying things got better slowly. That's all the economic news you needed to know during that 10-year period. And so I think there's a lot of truth.
I love talking about all this stuff, but every once in a while, I'm like, it's just sort of fun, but I don't know if anyone
I think that's an important topic. I've been open about how I invest. I dollar cost average into index funds, but I pay attention to the stock market every day. I read all the economic news. I read the Wall Street Journal every day because I think it's interesting. I think markets are interesting. And you don't need to take that news and become a day trader with that news. But I think markets are such a fascinating window into human behavior. And there's no other window that shows like how people think about greed and fear and risk, which are such important topics in all areas of life. But you see it in finance in a starker way than any other topic.
Morgan Housel, so great to finally have you on Odd Lots. Thank you so much. This was a really fun conversation.
Yeah, so perfect person for our first personal finance episode, I think.
This has been fun. Thanks, Tracy.
This was great. Thank you so much.
Thanks, guys.
I'm so glad we finally had Morgan on. That was great.
That was fantastic. And I'm looking forward to the new book for sure. I also thought the summary of markets and economics as like, it's not really about the line going up or down, but it's about the human beings involved in it, the emotions, the sort of like intellectual rigor around these ideas. That's the perfect way of summing it up.
Yeah, I totally agree because I basically am of this view. It's like, the economy will probably over time grow and the stock market over time will go up. And I don't want to just leave it at that because I do think all this stuff
that's your job.
Because it's my job. I want people to pay attention. But every once in a while I'm like, okay, why do we pay attention? And I think that Morgan captured it as you said right there. It's like, it's interesting. We learn a lot about how people think and how people behave. It doesn't necessarily mean like it makes sense to like try to like trade to like Morgan Stanley or Goldman's like S&P year-end price target or something like that.
I also thought the point about like one of the things that happened in COVID was the fracturing of people's experiences. I thought that was really interesting because I think the knee-jerk reaction to a global event like that is to think, oh, well, we all went through this big, history-making thing. But actually, as Morgan said, individual experiences varied widely, and I think it makes sense that might be one reason why people now are much more distrustful of what they're hearing on a sort of collective basis.
That was such a good point. That was like a light bulb because I guess on some level it's like maybe that seems obvious, but like that was really well put. And like I remember July 2020 and I was like, oh, things don't seem very good. But then I did like, I would like follow like these tech people. They're like, oh, I had like closed another deal today and, like over Zoom. And I was like, wow, like this is like.
Yeah, I'm working from home and like my personal wealth just went up by 10%.
Like that's really, that bifurcation is really striking. I also thought like this idea of like we had 3 in the span of less than 20 years.
Yeah.
9/11, 2001, the Great Financial Lehman, 2008, and then COVID. So less than 20 years, 3 like pretty like sort of earth-shattering moments of one way or another. Like you see like how like cumulative we just begin to expect like, oh, this is the norm.
No, totally. And I think people also react to those in different ways because some people might think, well, I need to save a ton of money because I never know when there's going to be a great recession coming up next and I'm going to lose my job. And other people might just think, screw it. none of this matters. Even if I accumulate all this wealth, put it in an index fund, maybe another 2008 happens tomorrow and it doesn't matter. So I'm going to buy an NFT instead.
Right. Or am I going to be happy with the 5% on the CD? Or, you know, like I always think, you know, about the Chinese economy, which does seem to have this same phenomenon of high savings rate.
Yeah.
But as you've written a lot about, like some of the most intense speculative culture in the world, like people like day trading, like iron ore futures at home and stuff like that.
Yeah,
pretty wild.
Exactly. All right. Well, shall we leave it there?
Let's leave it there.
Okay, this has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Morgan Housel, at Morgan Housel. Follow our producers, Carmen Rodriguez at Carmen Arman and Dash Bennett at Dashbot. And check out all of our podcasts at Bloomberg under the handle at Podcasts. And for more Odd Lots content, go to Bloomberg.com/oddlots. We have transcripts, a blog, and a newsletter. And check out our Discord, discord.gg/oddlots, where listeners like yourself are chatting 24/7 about all of these topics.
And if you enjoy Odd Lots, if you want us to do more personal finance episodes, then please leave us a positive review on your favorite podcast platform. Thanks for listening.